Hello, everyone, and welcome back to the podcast. As I have been anticipating for years, Spotify's free cash flow levels are rising exponentially. The graph that you can see on the screen now depicts soaring cumulative free cash flow production over the last 12 months. Spotify is a blueprint success story, a prime example of the type of company that I teach students to spot in my 2-hour deep dive course. Note that in the graph that you see on the screen, each bar represents the last 12 months, and you can see how throughout 2020 and 2023, the cumulative free cash flow levels actually plummeted as the company was making investments, specifically in the podcasting business. And now, as the different aspects of the thesis that I've been talking about for years have begun to unfold, free cash flow cumulative levels over the last 12 months have begun to skyrocket. And the increases are absolutely fantastic from September 2023 to June 2024. I was delighted to bet the ranch on Spotify at $97 because few companies on earth are as focused on maximizing customer lifetime value, LTV from now on. Management's laser focus on customer lifetime value increases Spotify's ability to capture value over the long term while simultaneously compounding goodwill with its customer base. Such improvements tend to equate into accelerating financials over time. Despite the lip service given by so many management teams, constant improvement is a rare quality that underpins some of the biggest successes in modern business history, such as Amazon, Walmart, and Costco. Spotify is a prime modern example of such property. Every additional dollar a company earns incentivizes additional competition and disruption from the market. The only way to produce durable profits, therefore, is to create increasingly insurmountable barriers to entry, capturing profits in lumpy increments as investments are made to fortify one's moat along the way. While this may sound simple on paper, only extraordinary managers are capable of doing this and foregoing current profits and Wall Street's adoration along the way in favor of long-term fortification. And this includes managers such as Daniel Ek, Spotify's CEO. Further, the market still does not widely acknowledge that in the network-defined economy, scale precedes profits. Spotify has been compounding scale and customer goodwill for nearly 2 decades now, which has put the company in a position to suddenly, and I say this in relative terms, proliferate free cash flow. So long as Spotify remains focused on LTV, recent leaps in free cash flow merely mark the beginning of their journey in offering immense shareholder value. The above graph, which I include on the screen again now for your convenience, is inexplicable to the untrained eye. But when it comes to networks, value manifests in the financials only years after laying the groundwork. Network effects do not show up in the income statement until the focus shifts towards monetization. However, companies with immense network effects are likely to also excel at capturing value. This is because both are simply the result of iterating the user experience better and faster than competitors. Over its lifetime, a company operating a network needs to oscillate between focusing on scale and profits to sustainably increase shareholder value. This requires timely modifications in the company's culture, an extraordinarily difficult task producing considerable short-term financial turbulence and stock price volatility. Yet, herein also lies the opportunity for savvy investors to buy when investment cycles, which precede greater profits, cause stock price dips due to myopic investors' negative sentiment. Identifying a Spotify of sorts early in its development is a highly qualitative exercise that transcends generally accepted financial knowledge. It requires understanding businesses deeply and on a first principles basis, which is what I essentially strive to do in my professional life and what I help others achieve via my deep dives and via my course, my 2-hour deep dive course. While some may believe that this is it for Spotify, I believe that this is just the beginning, and Spotify actually continues its journey towards becoming a super app. Spotify's financial progress over the last year is merely the result of some price increases, together with decreased investments in the podcasting business and leaner operating expenses. Going forward, Spotify can continue increasing free cash flow levels by solving big problems for both creators and fans, thus increasing lifetime value disproportionately from here and potentially even exponentially so. Since inception, I have seen the above as Spotify's path to a considerably higher market share. and market capitalization. However, this is the first quarter I see Daniel Ek making emphasis on Spotify's journey towards becoming a super app. When asked during the Q2 call how Spotify could go from 30% gross margins achieved nearly this quarter to 40% gross margins as laid out in the 2022 Investor Day, he said the following.
So overall, the most impactful thing I can probably state around where we're focused on is we're focused on solving problems in the intersection between creators and consumers.
Spotify's move into concerts exemplifies the above and addresses the problem for both creators and fans. For the former, concerts are a primary source of revenue, and for the latter, a primary source of enjoyment. By focusing its iterative efforts on making concerts more accessible for both parties, Spotify is likely to eventually yield a considerable source of additional revenue at a marginal cost. I believe Spotify will address many such consumer pain points over the coming years, with an increasing proportion of the resulting revenue accruing to the bottom line. The odds of an AWS equivalent emerging from this activity are high in my view, which could rapidly increase free cash flow levels over the coming decade, with the stock price following along over the long term. Further, Spotify is growing its user base fastest in developing nations, where monetization is most difficult, as you can see on the graph that's on the screen now. In Q2 2020, only 18% of all total users were in the part of the world that Spotify calls rest of the world, which really refers to developing nations. You can see that percentage has gone up to 33% as of Q2 2024. So obviously Spotify has to figure out a way to monetize these users as well as it does in the developed nations, where it has probably saturated the market. What I like about Spotify's path towards becoming a super app is that this opens up a path to monetization that relies on commerce instead of on subscriptions and advertising, which is traditionally two kinds of businesses which are more difficult in developing nations. Together with Spotify's ability to optimize LTV, such activity increases the odds of long-term success in these, for now, less affluent parts of the world. Going forward, I see a clear path towards a much higher valuation from here for Spotify over the long term, and I thus remain long. The investment is up over threefold for now, and I believe that this is soon going to evolve into a 10-bagger. So I remain long. And if you like this update, can I please ask you one favor? Please share this with one friend who you think will enjoy it. These updates and the deep dives are for free, so the only way this grows is with your help. Thank you very much. Until next time, and take care.